So anyway, welcome, I think, to everyone who's kind of joined and people who are joining in. This is the third edition of the learning session, part of the Pay It Forward series. And today, I think we're going to start off with Power Pact session to begin on fundraising. And then we have Gaurav Munjal from Unacademy talking about his experience on fundraising from the founder side. And then we have a very interesting session on team and culture, which will be the last session of the day. But I'm thrilled to, I think, welcome three of the most well-known investors, most well-respected investors in India. I think everybody kind of knows them, but just to kind of get things started, would love if folks can just talk a little bit about themselves and also either why they became an investor or something interesting that may not be publicly known, which they're comfortable sharing, and then we get started. Subrata, I'll maybe request you to kick things off.
Sure. Hey, thanks everyone. I can't see everybody who's out there, but I'm assuming it's not just the five of us talking to each other. Thanks for inviting me here. I'm part of Excel, and I have been now an investor for a really long time. Probably 2005 is when we started investing through Erasmic, and then became Excel along the journey, and even at Excel for now 12 years. One of the reasons that I became an investor was in the Valley. I was actually building a company during 9/11. And, as some of you are probably not old enough to know, but the guys who are, actually the entire Valley shut down post 9/11 and remained that way for a very long period of time. I actually had a term sheet just going into that incident, and that never materialized. So things became really tough, and we had to actually prematurely exit the company, sell it to somebody, fairly early. And at that time, I probably spoke to like literally 100 investors. And while what I thought we had a good value proposition, and other companies have come out in that space later, nobody was willing to listen. So I thought maybe there is something to be done here as a gap, which is, work closely with early stage founders, at least a handful of them, and kind of be a little bit more understanding of what issues founders face, etc. So that was the motivation. Thanks.
Thanks, Subrata. Anand, I'll maybe request you to go next.
Yeah, Karan, I was unlike Subrata, I was not a great successful entrepreneur, and most people who don't create great company, they tend to become VCs. At least in those days, it was the norm. So, yeah, the good part is that even if you are a moderate investor, you can angle into a panel with Subrata, and just because of Subrata, the panel will still be like top 3 investors, right? Including some in the bottom, it will still be top 3. So won't matter. So after exiting the company, I basically got pulled into another fund. It was called Seed Fund in 2007. We were early days. Probably Excel, Erasmic, and Seed Fund, and a few other funds were sort of very early in the whole ecosystem. And in fact, the word e-commerce wasn't common in India till 2010. We used to call it online selling and whatnot. And since then, I've been lucky to see the entire journey, right? Mostly voyeuristic pleasure of companies succeeding. And recently, a few of mine also succeeded. So it gives good satisfaction. That's about me. I belong to India Quotient. We invest checks of between $500,000 to $2 million at seed stage. Mostly paper plans, sometimes with some proof of concept.
Great. Thanks, Anand. Vaibhav, I'll ask you to go and then I'll reverse the order next time around.
Sure. Thanks, Karan, and good morning, everyone. So I'm Vaibhav Domkanwar from Better Capital. We're sort of a micro VC fund focused on pre-seed and seed stage. We usually do about 100K to a 500K check. We've exceeded that a little bit sometimes, but that's where we play. I think I've been an operator for 20 years, right? And I think over the last few years, I realized that there are founding teams I'm meeting who are just way more superior than I ever have been or could be. And I think that was the point where I said, instead of building another company, I might as well back some of these guys and learn from them. So I think really the journey is to partner with founders very early, give them a little bit of the experience that you've had. But I think we are seeing some of the best founders in the country. I've spent most of my life in the Silicon Valley, about 16 years. So there's a lot of DNA that comes from there. But what has been exciting is just the founding teams and the quality and what I get to work with at the idea stage. A lot of bad news in the stage where I am in, because most of the things, take a long time to materialize. But I think that's where it's been exciting. So that's the background.
No, awesome. I just on the lighter note, I knew I could never be a founder. So I said, what's the next best thing? And I talked to enough VCs for enough time. And thankfully somebody gave me a job 10 years back. So I think that's pretty lucky. And hopefully a lot of people have had their stories. But I think, look, I think the biggest part of the session really was to give more clarity to people, to founders, or, folks who are not necessarily familiar with fundraising, with the way the whole process works, and we'll get into some of the details. But overall, I think one of the biggest, what I've seen is one of the biggest things that people are not aware of is that there are different types of investors and different stages of investment, and not everybody kind of plays in everything, right? And Vaibhav, you kind of alluded to that, but if I can maybe ask you, right, what at the stage that you would typically come in, at the stage where you see companies, what I guess, what is it that you look for? But also, how do people who are investing at similar stages kind of evaluate companies, right? And I think getting a different perspective from each of you would be super helpful.
Sure. So look, I think I'm actually influenced by just being an operator for a very long time. So I'm, like I said, growing up in Silicon Valley, I think you had to either code or do everything else. I didn't code, so I did everything else. You had to be severely hands-on, right? And I think I enjoy it. So I think what I look for, so I'm a market-first investor, and I think it's often misunderstood, right? Market first doesn't mean founder second, right? I think a stellar founding team that you can relate to is table stakes, right? But beyond that, as somebody who is sold, I do growth, everything myself, hands-on quite a bit. So for me, it's really about ability to touch and feel the market, and then obviously evaluate if the founding team can pull off, right? I mean, what's been their experience? And I think the best way I try to look at it is, because we are at the very early stages, several times very idea stage, pre-PMF all the time. What I'm looking for is really the learning loop of the founders, right? How fast can they learn? Because I don't know the right answer either. Nobody knows, right? So I think a market that I can tangibly relate to, and the learning loop of the founders, that's been the most critical for us.
And I'll maybe just go one level deeper in that and have this question for everybody, because we all talk about team and market being the most important thing. But from where you sit, your vantage point, market maybe is a little bit easier in some cases, at least relatively. But what do you look for in the team? Just your thought process around, because there's no right answer, frankly.
You want me to go first, Karan?
Yeah, please. And then I think I'll ask the same questions to
Yeah. So I think, look, I think this is where I think the personality of every investor comes out, and we will all make a lot of mistakes and we'll be correct a few times. But I think, so I'm definitely behind a mission-oriented founder. Mercenaries is something, it's a hard line to walk. I think very few people that I've come across have done that right, to be value driven, I think, right? So I think for me, besides the fast learning loop, I think it just goes back to the value system of the founders. If you meet a whole bunch of our founders, you'll find some similarity from that perspective. So I think that goes a long way, because again, when I'm investing, it's just so much about the mission and passion and everything, right? And unless you are doing it for the right reason, which is what I'm looking for, besides the learning loop, I think that goes the longest way. So I think that's where sometimes we don't get enough time to evaluate that just on fast moving deals. But whenever I do, I think I just try to work with the founders so that it helps me understand, the real motivation behind doing whatever they're doing. Because, we've all had situations where, 6 months, 9 months into something, they just lose interest. And I've never understood how I made a mistake in not realizing that sooner. So that's what I'm looking for the most at my stage.
Anand, since seed fund and when you start, I remember when you guys started IQ, you've seen it from, and you've also like played at different stages within the early stage, right? But how has that kind of evolved in your mind, and where do you guys see kind of yourselves today? And similar question to what I asked Weber, right? In terms of the team and the market, how do you guys want to, how do you guys look at sort of looking at evaluating it?
So Karan, of course, it's market, right? That's the most important, right? Because sometimes you meet very good people, right? And you don't have something what you call as an investor market fit. Right? I've coined this term for myself, just to know where I should play, where I should not play. Right? I'll give an example. There are some businesses. I mean, just take an example of a company like Bounce, right? Ride sharing. Now the table stakes for a single city might be like tens or twenties of millions of dollars, right? And that would be the seed check, right? For starting something like a Bounce, right? A ride share company, or Ola for that matter, or Uber, or those kind of companies. Uh, and those are well discovered models, right? So it's not like I have anything special to add there in terms of discovering the market. And there we sort of are very shy unless we think we really have an edge in discovering that market a little early. Otherwise, there's no point, right? I mean, bigger funds like Subrata or Sequoia or such funds will probably have an edge over us. So we try to see that, and sometimes we get really great teams. But if we are really the third or fourth player, or likely to be the third or fourth player in terms of funding, in terms of speed or such stage, no point in getting into there. What we try to do is to discover new sectors, and and ideally things which are not sectors today. I mean, agri is an example, for example, or software for Indian small businesses, for example, which is sort of what our firm is working on right now. Indian businesses, paid software, free software for Indian businesses. That's a new thing. And typically we also classify things into winner take all businesses and not winner take all businesses, try to strike a portfolio balance between the two, right? So it's largely about market, and then immediately you jump to founder market fit, where you Vaibhav very nicely said, right? Missionary and mercenary. But there are some markets where you actually need mercenary founders. I mean, I'll not discount that. So there will be some markets which are largely about land grab, largely about getting size, largely about the initial leadership or critical mass and those kind of things, right? Network effects. You need mercenary founders there, or at least a mercenary trait, right? Which will sort of say, okay, I have only a single goal of being the number one in this market, right? And the rest of the other things will fall into place later. And then there are some founders in some spaces, particularly when you are discovering a new sector, right? You need a missionary founder, because this founder has to be somebody who believes in himself so much, is happy to spend a few years before people start believing him, right? He's not looking at validation from every VC, because till a sector becomes commonplace, most people will sort of laugh at you, at least not understand or appreciate what you're doing. Another thing that we look at in terms of what kind of founder, what kind of skills the founder to business model fit. So if your business is very tech heavy, in a social media company, for example, I look for a very high quality tech team, right? And I have faltered with so many good people, even good product managers, but didn't have a good CTO, right? A good tech guy, right? Specifically for social media. Or similarly, if you want to do a brand, or if you want to do a lending company, you will look for people, at least one founder, to have the domain experience. So look at what is critical to the success of this company, and does the founder bring that or not? So
yeah, and I think we'll sort of touch upon some of these things, right? In terms of how they should also look for an investor.
Yeah,
but
absolutely.
Yeah.
Absolutely.
So, like, given that you guys invest very early, and then you kind of also look at slightly more evolved, mature companies, and you kind of seen the ecosystem evolve in front of you over the last 10, 15 years. Um, Again, just what would be your input to founders when they're looking at investors, right? In terms of different stages, how they should think about approaching them, and maybe what's the right way to think about that? Because most people don't know, when, how, and who to approach.
Yeah, before I go there, just one comment on the previous discussion. I think it was touched upon, but it is important to figure out, how a company gets to, let's say, a product market fit and then the scale. So when you come in, I mean, if this is a business model that is well known, I think that was alluded to before, the kind of team that you look for is a little different from a situation where you will actually have to, and I think Anand was talking about, uh, things that are not even a category yet. So there you don't even know the business model, right? So you don't know how you're going to make money. And there will be, plentiful more bad days in that evolution of the company than, good days. And it will probably take years before you figure out, who's willing to pay and why. So clearly two different kinds of founders. And in the second one, which is, I think, increasingly going to become more commonplace, because a lot of the ones where the business models are known are going to be taken, either already or going to get taken relatively quickly. So we'll see more and more of these situations where it's a sort of a new way of making money. And then the ability for the founder to follow the money, right? So how is the profit pools in that particular industry organized, and why should that shift? And generally it may not shift significantly, but it might shift a little bit. And usually it is because of new technologies, so cloud or mobility and things like that. And once you understand that nuance, does the team, first one, understand that nuance, and two, do they have the ability to execute on it at a certain level of competence and efficiency, because that's what will get them to win. So now I'll go back to the other question. So clearly we have started to do a little bit more broad-based investing in India. But if you look at our data, still 85% of the time we are the first check into a company. So predominantly it's still early stage. And going into early stage, what we do is, again, do this breakup that is it something where the business model is known, or is it a completely different, business? And, like I alluded to, so slightly different ways of analyzing those two situations. I think it is also important that there is a sort of a founder investor fit, right? I mean, clearly we have talked about a founder market fit, but there is also a need for a founder investor fit. And for example, I love doing early stage, right? And whereas our Anand Daniel, who's also part of this panel, he loves slightly different, slightly more mature businesses where certain things have started to show through, right? And clearly, we have different criteria that we apply to evaluate the team or the market for that matter, right? And so that's one piece of it. And then there comes a situation where we have gotten into, let's say, companies like Browser Stack, where it was already either profitable or close to profitable, or Book My Show and some of these companies. And then it's a completely different set of metrics that you go by, right? So obviously you try to analyze, what is the company's valuation today with respect to their current set of metrics, and how much of headroom is there, how much can you scale, what is working, is this a market leader? And, so that's a completely different set of analysis that we do. Did that kind of answer the question?
Yeah. I think, maybe going back to one of the points you made, and this is also a question somebody's asked, if I can maybe put that to you and then the others, where I think where a lot of the knowns are, people are aware of, I think that's one line. But I know all of us also face situations where market is evolving or a business model is completely unclear. So how do we as investors, how do you guys as investors think about both the market size, the scalability, monetization, at least in the early days, right? Obviously, once it evolves, it's a different thing. But Subhata, maybe if you can touch upon that, because that's something you also brought up.
Yeah, I don't think there's a formula, obviously. I mean, then we'd all be doing the same thing. So a lot of it is the gut feel about from the investor about that market. So I may have thought about a particular problem, and I might therefore have a little bit better ability to take a risk on that particular area. And sometimes that's very difficult to figure out ahead of time for an entrepreneur. But for example, our journey into something like a Ninja cart, which was in fresh in the early days, and actually the pivot happened a little bit after we came in, but we were probably ready for the pivot as soon as the founders were, because we had actually thought about what are some of the key ingredients of the space that they were looking into, and how does one actually make money in a model like that. So that's sort of one side of the story, which is, has the investor thought deeply about the set of problems that might show up in that specific space, and if that happens, it's easier for that investor to appreciate the risk and therefore take an early bet. And obviously, a lot of us, what we are doing is taking a large risk on a small amount of check, small amount of money, and we just weigh out, this is how much I understand. Here is this team which obviously understands more than I do, but what are the risks am I taking versus if it were to work, what could be the outcome, right? So that if somebody has thought about the area, I think it just becomes a little bit easier to take that call in terms of how much risk for what kind of outcome are you going at.
Anand, can I just maybe put that to you also? And I mean, feel free to give examples. Those are sort of best ways. I think when you guys invested in ShareChat, that may be one, but any other examples you would give of that kind of a situation would be helpful.
Yeah, Karan, the refined tastes of other investors, right? That's my opportunity, right? I mean, what I look for is something that is ugly, but growing like weed. Right? I mean, that is my opportunity. And of course, everybody has their own way. I mean, beauty lies in the eyes of the beholder, right? So ugly is my way of looking at it. It's not just about traction; it's about potential traction. Right? ShareChat is a good example, right? I mean, the kind of initial content that was shared on ShareChat was like really, really crass. And what happened was that when we launched the product, the first cut of the product actually attracted mostly the engineers and IIT students and all of that. Okay, because they are the first ones to want to adopt any new product and all that, and the company had to shut down English as a language. Right? We said no, we don't want English-speaking people to crowd out. I mean, for example, if you look at Twitter today, right, it's crowding out normal people, right? People who can't really have perfect grammar and perfect punchy sentences. Twitter is not for them. Right? So we stopped that, and that is sort of what told me that it's just a matter of time, right? You just have to visualize the future. It's just a matter of time, and we were pre-Geo, right? So frankly, Geo changed the game for us a little too soon. But the expectation was that given enough time, enough people will have smartphones, but not have English language, right? Or a taste for Netflix and all of that kind of content. Right? The other company very recently, Karan, was a company called Vyapar. Right? Again, seemingly a very ugly market where you are charging 1,000 rupees a year or 2,000 rupees a year to really small merchants. Right? And the argument there was these people don't pay. They will never pay. There aren't enough of them. Even if there are enough of them, they are crooks. They pilfer software. They pirate everything. They're used to all of that. Right? But the thing is that if you look at what's happening in the rest of their world, right, they are also the same people who are paying for Hotstar to watch cricket, right? Because they are the businessmen. They have the most time, right? So they are using Amazon Prime, for example. In fact, a lot of these people don't do a lot of deliveries, but pay for Amazon Prime to watch the content. Same people also actually are forced to apply online for their government registration and all, right? Bulk of the government work is online, right? So there is a family CTO, right? And this is something one founder came and told me. He said, हर family के अंदर एक CTO होता है. Well, he's the elder son, elder daughter, somebody is there, right? Maybe whichever son or daughter, she or he is the family CTO and actually makes all the tech purchase decisions of the family. Right? And this was a very good learning for me. Right? Okay, there is somebody in the family who's deciding all of these things, and he or she at some point might even decide to pay, because if you have a CTO in the family, they'll take a call like 1,000 rupees, right? It's not a big deal as such. And that was an insight which came only from a particular kind of founder. Right? And there the learning was simply that if the market is really big enough, right, It will help us discover the price, help us discover, what the product should be. It will pull both pricing, product positioning, everything out of the founder, right? The founder has to be willing and capable of delivering it. That's how we looked at it. So
Weber, I'll just ask a different kind of a question, right? Because this is something I think all of us would have seen, and would love to get views from each of you. But are all businesses inherently fundable by third parties? A, B, should that be necessarily from a fund because there is a certain halo around raising money from a VC fund? How should people think about that? And I used to think it's not politically right to say, look, your business may or may not be necessarily there. But as a venture investor or as an investor generally, how do you deal with that? And what's the right thing to tell founders, right? Because that the whole question of bootstrapping versus raising money versus who to raise money from kind of gets answered in this way.
Yep. No, so, I'll just touch on a couple of quick examples in the earlier question because I think it's a very relevant one. I think 2 points. Investor market fit is very important because there are some investors who will believe in something much earlier than everybody else for whatever reason, for their own experiences and things like that. So that goes a long way in terms of, how you end up identifying something. And we had a couple of great examples, right? So I was kind of a pre-seed investor in the neobanks. I guess Open we can consider as the first real neobank in India, right? And I think that went back to my experience about 10 years ago. There was a company in the US called Simple, which basically said, hey, banking is broken. I want to kind of create a new kind of bank. And they went through a very, I just read through them, through their journey. They were a little early. So that's when I first spoke to Anish, it was actually a weekend long call that that convinced me because of that experience. And the second part was the fact that they had done small business and on the ground and payments and everything, right? So I think that founders, investors connection with a certain market can go a long way. And I think, that has played out for us in Khata Book, in Teachment, and a few others as well. So I think that's something something to pay attention to.
Right.
Having said that, I think so the very related question is somebody fundable? Is a neobank fundable? Is a Khata Book fundable? Is a Teachment fundable? I mean, a lot of it goes back to what we're talking about now around SME digitization, or like Anand mentioned, like how do you sell to people where I still don't believe they will pay, but I think they will pay, right? Because like Anand mentioned, I think they're paying for Hotstar Prime and things like that, right? So they will pay. So I think there are two ways to look at it, right? There is a category of companies where you just know that it's just not going to work, right? It's just too unscalable, very fundamentally. Right. And I think my approach is, I do these 30-minute calls with, I don't know, several hundred founders every year. Right. And I think on those calls, my objective is really to give them brutally honest feedback, but not in a judgmental way. Right. Because I've been an operator for a long time, and I think I know how hard it is in general. Right. So I think my approach is essentially to not give a good feel-good answer, but instead give them a right answer, but in a way that is not judging them or their business or their view of it, but more in a constructive way. It's a very hard one sometimes, and sometimes people like it, sometimes people don't. But I feel it can go the longest way, right? Now that doesn't mean it depends on how much you know the founder, right? Or where if a existing portco founder has referred somebody, then I'll do a better effort. If it is a complete cold conversation, then I don't know the person enough to be brutally honest or not, right? So I think I would meter that down a little bit. But I think that is one part. I think the second part is, the business is fundable, but different investors might have different views of it. Right. And that's the trickiest one, because I think in an evolving ecosystem like ours, where I think we have a fairly shallow investor ecosystem still, right? I think we need to be 10x more, because I think that will give more views to stand out in the ecosystem, right? So that's the hard one for founders, I think, today, where I may not get it, but it actually may be a really good company, right? And I think that's a situation where I guess my best approach is just to say that, hey, what are the reasons I don't get it, right? So, for example, there is a very interesting founder I just spoke with yesterday who has done a sort of an impact-oriented work, but is now ready to kind of create the venture scale company out of it. And I just know how hard that is, right? Mental shift, thinking. She's thinking of 1/10 the scale that she wants to think about, right? But then I still want to help those founders because I think I have a investor market fit in that case where I think the right set of values can help create a large company. So I think that is the part that is the trickiest, where how do you find the investor market fit where you are committed, but then the founder market and the founder investor market, that triangle is the hard part.
Yeah, and I think those are some important points you touch upon. So with that, I'll maybe put that question to you as well in terms of how, and you would have seen so many examples right over the last many years on businesses that are inherently fundable, potentially not fundable. What's the best way that either an investor can share that with the founder, and how should a founder also think about that? And then I'd love to just talk to you about how founders should then think about approaching investors in terms of doing the diligence on them, who's the right investor, even within a partnership, right? Let's say within Accel, who would be the right person? So I think that part also gets missed out, but it's increasingly important as our ecosystem grows.
Yeah. No, so to the first point, I think what will happen is, how do you really figure out, that so let me take the second question first, right? So let's talk about, let's say, how within a large firm, so for example, at Accel, we have now, I think, 11 people who are independently making new investment decisions, right? And that's a fairly large group. So, and one of the things that we have done right from the beginning is to foster diversity of thinking. And if you look at all our partners, we will probably, if we had to vote, we'll never invest in any company ever, right? Because it is that diverse. But we do, manage to invest all the time and at a fairly rapid pace because we have made everything fairly decentralized. So if we believe that, you have a particular reason to kind of like a particular set of people and an opportunity, then in our opinion, you should make that case with the rest of the partnership and go forward, right? So to that extent, a firm like Accel is almost, there are probably 4 or 5 buckets of investors that you can look at. So people who do SaaS and do SaaS a little early, people who do SaaS but want to see a little bit more data. There are people who do consumer but like early, and then there, so all those. I mean, and sometimes from an outside perspective, it becomes a little hard to exactly figure out, which partner is the right one for you. But I think it is worth doing that exercise, and not just for Accel, for any fund. And some of the things you should do is probably go back and look at all the companies that they have at least announced that they are on the boards of. If possible, talk to some of those founders. Get a sense of what is it that this investor actually brings to the table. Forget about what they like or don't like, but what do they bring to the table? And is that piece important for you? Right? And if you can align that, and hopefully that particular investor also likes you, then I think the journey becomes a lot easier because at least you have alignment of thought and things like that. Right? So yeah.
Sorry, Siddharth.
No, go for it.
Go on.
Karan, the question that we are all as investors, by and large trying to answer is this company going to reach 100 million net revenue, maybe 200 million net revenue, depending on your fund size? is it going to reach there during the lifetime of the fund, maybe 7, 8, 10 years? Ideally 7 years only. Is it going to reach there or not? Right? Now, when you ask that question to founders, and sometimes we do ask this explicit question, right? Founders themselves then think, do I really want to build a 100 million revenue company? I may not want to build, right? Because that's not what I thought about. Right? And I myself don't think the market is so large. I myself don't want it to be such a large company. And there might still be some pools of money where you want to build a 20 million, $50 million company, maybe lesser, and want to sell it out. Right? Maybe you want to build a piece of technology which will be desirable by a lot of other people, and they want to buy you out. Right? That's a good question to be answered. And that filter particularly, helps founders to understand whether they should approach VC funding or not. The other question is, are you getting any specific technology leverage or not? Right? Bulk of the VCs, and of course now there are some specialist VCs who are sort of looking at pure FMCG kind of brands, but bulk of the VCs would want some, serious technology leverage in the business model, whichever way you use the technology. So these two questions filter out for me, whether I think the company is VC fundable or fundable by me or not.
So yeah, I kind of stopped in the middle because I started thinking about one or two other dimensions to it. And the one company that I have been involved right from the beginning and did very well was Mu Sigma. I think for all it is worth, he could have built that company without any VC funds. True. Because effectively we put in a 350K of seed, and then Dheeraj raised another $1.5 million, but he was already profitable at that time. And then practically every other round that we have raised was to buy out some investor or the founders, part of the founders shares, right? So effectively, I think that business could have been built without any external money. I mean, that 350K out of that 100 was actually Dheeraj himself, right? And it was just, I would go back and say, Dheeraj really wanted people like Ashish Gupta and me on around the table. And that's why he raised money from us. So I would just, and maybe none of us knew what the outcome would be at that point, and that could be the other angle to it. But there are these situations where a company could have actually not raised any money and done everything on their own terms, but they did because the founder thought, just having certain people around the board might be actually useful. So that's one reason why you might want to raise money even though you don't need to. But I think what Anand was saying is also important because, but the challenge, of course, I find is when you get started, Classical was Flipkart. When we got started, we thought we'd be like, 50 million GMV and we'll exit for 200, right? It'll probably take us $20 more million to get there, right? So we are coming in and 200 million exit. Let's say another 25% of dilution. And these are the discussions I had with Sachin and Vidhi, right? So I don't think any of us really knew how quickly e-commerce was going to grow. I mean, we knew what e-commerce was. We knew that it could grow, but we had no idea, that we are at the cusp of the right timing, right? So I think a lot of those things make it really difficult to figure out whether a company should be VC fundable or not. But I think the best thing is to go approach a few and see how they're reacting to your business, right? I mean, don't make a perception of it. And not to say that the VCs are any smarter than the founders. I mean, they're not. But at least they have a perspective of things that they have seen to define their own logics in the past, right? So is there a pattern that they can bring to the table saying, let's say what both these guys said about Indian small businesses adopting technology, right? I still believe it will take a long time to happen, right? But maybe somebody else believes that it will happen in 5 years, right? And a lot of time that is the single most important decision criteria, that in our lifetime, in the next 5 years, that is this company going to get to, forget 100, even 20, 30 million of revenues.
Anand, I'll go back to something you said, right? Because I've seen, and I'm sure all of us have seen this. Now, let's say if we use that filter of 100 million revenue, which I think a lot of people do.
Yeah.
But what should entrepreneurs or founders do when they're like, look, I'm not, I can't build a company that big because I don't want to. B, the market opportunity may not be that large, but I can still build a nice, let's say 20 million revenue company, which is significant. Question, how should they think about raising capital? Because they may still need some external capital, right? So that's the part which gets missed out.
Yeah, I think it's tough to predict the market, right? And I have like Subrata said, right? I mean, we have all bow down to market. Market is God, right? I mean, like you simply bow down to the market. You just listen to whatever it says, right? And whatever it does, right? And you don't try to predict it too much. You try to judge it. But I think more importantly, the ambition of the founder is important, right? And many founders themselves have been very, very, very honest, right? Saying that, no, I'm not really thinking of, building a 100 million revenue company. Right? And this honesty helps, right? Helps them understand themselves. And this is all, right? I mean, if I really feel that there is something there in the founder and the market doesn't seem like 100 million to me, but it doesn't matter, right? I mean, it's still a large space and eventually it will become, right? If the founder demonstrates ambition, right? And maybe we can go into go into how do you demonstrate the ambition, right? What's the proof, right? Somebody asked the question on the chat box, is traction important, right? I'm not looking at traction per se, right? But what are the things that you can do to prove that this is a large market, right? And hence I've been able to hire the best people I know, right? Or the smartest people. I've been able to convince them to join me. And hence I'm really ambitious to build a large market. The fact that I am sharing space with 3 other co-founders also means that, I'm, and very high caliber people, right? I really, really worked hard to get them on board. Right? Those kind of things will demonstrate the ambition of the founder to really build a large company. Whereas there are some founders who sort of demonstrate there's the kind of people they hire and they try to work the initial team, maybe of even 5-7 people, right? That doesn't really give you a feeling that this is going in the direction of a very large company. You look for some initial signs, hardly any signs, right? Just try to guess, right? Maybe just talk, look at responses and all of that.
So just add in a quick point.
No, go for it.
Yeah. So just a quick point there. I think ambition is a very important trait. I'm sure all of us look for, right? But one of the things I've seen is ambition is expandable as well, right? So when a founder actually gets to 20 million, he starts to think that, hey, I actually can get to 100 million.
Yeah.
Right. So that goes a long way sometimes. And in fact, if you look at Jason Lemkin, who actually probably talks the best about SaaS in general, I think he's almost proved through so many examples that once you get to the 5-10, which is the hardest journey, you don't want to stop, because the 10 to 20 to 30 to 100 is going to be far easier, in the sense that there is a template and there'll be more people to help you. Right. So I think while we are all sort of looking for that 100 million model, I think sometimes we can break it up and say that, hey, why don't we get out of the gate here, right? And figure out what works. And then as long as we can believe that the founder's ambition is expandable, and mostly it will be, right? Nobody wants to give their life's work to something and just say, okay, I'm done, right? Because I think it expands. So I think maybe we want to kind of sometimes, especially in new categories like Anand mentioned, I've done a bunch of agri as well, where I think the idea is, let's just get out of the gate, right? And then figure out. So that's one view that I try not to model that 100 million too much.
No, it's exactly what I was going to say. And I see it in myself, right? So when we first went into Flipkart, it was a small fund. I would have been happy with the 200 million exit where we held, 20-25%, right? And we would have paid for most of the fund. Today, I, at least starting out, I'm looking for like $1 billion, right? And that's human nature. And obviously at Flipkart, when we got to 200, and we didn't actually even get to 200. We went from, 50 to 250. I think all of a sudden our eyes opened up to the possibility that this is way bigger than what any of us had thought. And part of it was Tiger coming in and getting us to go look at some of the e-commerce companies that they had invested in China, and our like eyes lit up, right? So China 10 years ago was like us, and look at JD, which was like the number 3 or number 4 e-commerce company, was actually cranking it up like crazy. So I think we are all we understand this whole relative grading very well, and that's human nature. So once thrown into that challenge, most people will actually figure out how to overcome that challenge, and it's just.
Karan, I have an example
Yeah,
of Rebel Foods, right? It was called Fasos, right? The company actually started in 2003. Jaideep was junior from IIM Lucknow and also my colleague in my first startup. We had worked together for 3 years already. He was my star sales guy in Europe, based out of London. And he came back one day and Anand, I want my bonus. I said, dude, where are you going? No, I'm not going anywhere. I just want my bonus. I said, no, what's happening? And he's like, in a startup, normally the cash flow issues are like bonuses are accrued, right? It's very difficult to give them out. So he said, no, I want to start a restaurant. Okay? It's 2003 somewhere. Okay? And he actually put his bonus and the rest of his life saving, his wife's savings into a very fancy walk-in restaurant called Fasos. Okay, and this was supposed to be about Bengali food, right? And this was just a passion project, right? It is very classic passion project. Mostly such passion projects are done by people who are like, in the midlife crisis. He was very young, right? He didn't even have a midlife crisis, but still a passion project. And from there, got stuck naturally, right? Like most other restaurants. And then he again touched upon the idea of doing only delivery only outlets way back in 2004, right? And I kept working on the business model and on his brain that he doesn't want to do this and all of that. Eventually got fed up of life, went to INSEAD to do another MBA, right? Joined McKinsey, and I met him again in 2010. 2009 I met him and I said, like, dude, I first have to want to become a partner. That's my short-term goal. The day I become a partner in McKinsey, I will talk to you again. I met him the next year in London again. And this time he said, I'm ready, right? I'm just expecting my whatever partnership to come back. And he came back to India. We started again with a single brand. Of course, nobody believed that, you could actually build a great business out of a restaurant chain, right? I ended up being the only angel investor in the company. But from a single, outlet based, single brand company, over the 10 years, you have to really see the evolution of the company, right? I mean, not just in terms of the amount of funds they've raised, but the kind of things they've done and achieved, right? And the kind of organization that has been built, right? And of course, the ambition has expanded, right? All the time, right? Every stage, right? And to some extent, you have to give the credit to people around him, right? In fact, I mean, I was more on the receiving end of the advice he was getting, and but fabulous work, and completely agree, right? I mean, sometimes it's just a matter of time, and founders have to love their idea enough. And the other point is also that what everybody was alluding to, you just need one investor to like you, right? So you don't have to keep tailoring your business plan, your approach, or anything for that matter, till you've heard everybody out, right? And probably there are very few of us in India. That's the sad part, right? But then there are enough of us, and you don't really have to worry too much till you heard everybody out once at least, right? And keep. I mean, I have changed my mind. Vyapar, for example, right? The guy pitched to me. I spoke to him, and I funded him a year later. Right?
So that's a great segue to my last question, because this question comes, I think, on the chat and on Q&A. When should people approach investors? How should they approach investors? I think we touched upon this earlier, but just to maybe talk about that a little bit more. And if someone, Anna, like you said, right, says maybe no, not right now, what's the best way to stay in touch? People shouldn't get disheartened.
Yeah, I want Subrata's answer on this. Subrata hasn't funded any of my companies yet, so
You're not sending enough to me, man. So I think it's about life, right? So the beauty of the best founders is they never give up.
Yeah.
Yeah, there are so many stories of where you go through the bad times and you keep trudging along, and then sort of, I'm sure COVID has done that to a bunch of companies, right? So it has actually kind of given fillip to a bunch of these internet companies. For example, on the education side, there are a ton of these new companies that were probably going sideways, and today all of a sudden they have this little gust of wind that they can actually start flying back again. So you really don't know what the drivers of the markets are. And all you have to do is to find that niche where some set of customers actually feel like you solve their problem better than anybody else, right? And it's an iterative process. And it's true for your customers. It's true for your investors. I mean, it's actually true for co-founders, because if the journey is long, sometimes people just don't see things aligned anyway, right? So you'll have to kind of keep doing this. It's just a hard thing that you have to keep at it forever and ever. And sometimes it'll work, sometimes it won't. But that's true for all aspects of company building.
Vaibhav, last word to you. I think almost out, but
yeah. So, I'll pick up a couple of questions from the chat as well. So I think how founders should approach investors is always like there's no perfect answer to it, right? But what I've seen is founders who are able to articulate their vision constantly definitely catch attention, because anybody who can articulate what they're looking to do and what their ambition is, what their vision is, definitely somebody I like to speak with, right? So there are some founders, whether it's LinkedIn, Twitter, whatever it is, I think they're very articulate about what they're trying to build, and I think it's very educating with the best founders, right? So that's one way you can stand out. I don't think enough founders write about what they're doing and in a way that can be educating to me or any other investor, right? So I think that's something I would highly recommend. The second is, I think essentially the best way is to actually rise through the noise and get introduction through funded portfolio companies, right? So the other founders introducing is probably, I'll make a special effort to make sure I don't miss that, right? Because I think everybody just gets too many and there's only so much time. So I think these are the two I would say. And I think the keeping in touch is something that I have a little bit of a contrarian opinion, because sometimes what I feel is if somebody has passed on a particular company, you're unlikely to change your predisposed opinion about that market, right? Because a large number of times, if you've passed for something very deep. And if you have not passed for something very deep, then you are keeping in touch anyway, right? So if an investor is not keeping in touch, I think I'd rather have the founder build quietly, prove a whole bunch of things, and then hit me back again or any other investor saying that, hey, look, I know we didn't get this. But I think that keeping in touch sometimes, I think, just creates this whole who wants whom kind of a thing, because I think we don't talk about it enough. But I think you have to sometimes be very smart about how you fundraise, right? So smart about how you create momentum around your vision and what you're building and things like that. And I think it's an art and less of a science, unfortunately. So some founders get it, some founders don't. But I think from keeping in touch with investors, I'd probably not do regular updates. I'd probably say, hey, 6 months, and I go back with a set of key achievements that actually take a whole bunch of more boxes.
Got it.
Just one question I want to
15 seconds.
Yeah.
Sorry, just one question about, somebody commented that, a lot of, we only fund IITs. It's an important one, just address that. Not true. Except that the onus of proving your capabilities is a little higher, and plus you can work in a startup, you can gain some credentials, right? Or just have even more rigorous proof. It might take a little longer, but not true. Most of our companies, most of the VCs will have enough number of non-IIT founders, right? or non-Premier League founders now.
I think that's happening more and more now.
More and more, absolutely.
So one little thing, a comment on what Weber was saying. I think at Accel, we do believe that there is no last word on any area, any idea. I mean, it's a journey, so it's a point of time kind of thing. So we normally would tell a founder whether we are interested in the space or not, and otherwise we'd probably not even take a meeting. But if you're interested in the space and for some reason we passed on a company, we would actually encourage those people to come back and talk to us, you know, and obviously at their discretion because we did pass. But there are always these opportunities to reconnect back. So, for example, some of my companies where other people have passed on a Series B, I keep telling them that, you know, if you are in the payment space and these investors have invested in payments companies and they don't have a conflicting investment, we should continue to update them. So it's a little bit more nuanced, but don't sort of, you know, give up. Right?
Yeah. However, I sometimes regret that people didn't write back to me, right? So I always, whenever I send a regret mail, I say, please keep in touch. So I agree with Subrat there.
That's why I said it's a little contrarian.
Yeah.
But look, I think that's a great
Super.
sort of note to end on. I think we could have gone on for another hour, but since we're kind of out of time, thanks so much to all of you for taking the time. And I think we've hopefully been able to answer most of the questions people had. I'm also just sharing a link on the chat for feedback, you know, on the session. So please do reply on that. But Subrata, Anand, Deva, thank you so much. Thank you for being part of this.
Thanks, Karan. Thanks, everyone.
Bye-bye.
Bye.
Thank you. Great. I think we'll move on to the next part. Hi, Gaurav.
Hey Karan, how are you?
Hi. Good morning. Morning. Good to have you here. I think we're waiting for Mukul to also just
I think
Mukul to
he
join.
has
There he is. So we're right on time. I'm not going to waste any of your time that we've got allocated. So the next session is Mukul having a chat with Gaurav on his fundraising journey and sort of lessons learned. Mukul, I'll let you take it away.
Sounds good, Karan.
Okay.
Thank you. Thanks. Hi, Gaurav. How are you?
Mukul, how are you? Long time.
Yes, long time. Okay, thanks a lot for taking time out for this, Gaurav. And welcome to all our participants. Hope everyone is staying safe and healthy. So, Gaurav, as you know, the agenda of this discussion is for you to walk through your journey and specifically on the fundraise side and share your learnings and very sort of actionable insights with the participants. And you may know just before this, there was a VC panel where the investors have shared their side of the story on sort of tips for raising capital. And now it's time for the real stuff and hearing from a founder what are some of the best practices for raising capital. Before we go there, would love to have you spend a minute on what is Unacademy and what is your vision for Unacademy. I'm sure most people are aware, but will be great to start from there and then we can jump into fundraise.
I mean, when we started, it started long back when the founders were in college, and we started as a YouTube channel, and then eventually we started building tools for educators to create free content and share that with everyone. And I think at some point our vision became to help people achieve their life goals by empowering them and by getting them access to experts. And that's what we see, that in tier 2 cities, tier 3 cities, the kind of coaching that, for example, right now we are in test prep, the kind of coaching that was only available to people, which was sort of a privilege, and it was only available in cities like Delhi and Kota, and you had to pay a lot of money, is now 1/5 of the cost, and there is no transportation or accommodation cost needed, etc. So we are sort of empowering people to achieve their life goals, whether it's exams or anything else. For example, right now we have 15 grandmasters of chess teaching chess to people who want to make a career in chess. So wherever it's about serious life goals, our goal is that we will help people achieve that, and we just have gotten started.
Awesome, Gaurav. I think thankfully I've been fortunate to see some of these things up close and having seen the way our ambition has expanded over the years and what we are trying to achieve. It's just phenomenal. So, Gaurav, moving on to the fundraise side, you have been a founder twice. You started Flat Chat earlier and then Unacademy, and both the companies had very different journeys in terms of capital raise. Obviously, both were started at different times, both were very different businesses, but still, I'm sure there would have been some learnings specific to capital raise, which you would have brought from Flat Chat to Unacademy. Would love to start from those.
I think I think founders take their fundraise too seriously, and I think I think Mukul, your video is not proper. I think, but
There is a lag. But yeah, so I'll try and fix it. But yeah, let's keep
is
going.
my video clear?
Yes, yes.
Yeah, go ahead.
Okay, so I think during Flat Chat days when I had my first experiences with investors, what I really realized is that people are interested in the story. Yes, people are interested in data, but in very early stages, it's about the story, it's about the mission, it's about why that particular problem is so dear to you. Why is this team, why are these founders the best people to solve that particular problem? And when you start working towards that, when you start focusing on that, and you tell that story that, hey, this team is the best team to crack this problem, I think that's more important than the market, than the size, than anything else. Because the best founders always pivot, the best companies always pivot, they figure something out. So at the end of the day, I think what's important is, and whether it was the first investors I ever met when I was 23 years old, or even my last fundraise, I think it's always about, is this the team for this particular market? And I think in the initial stages, the importance of team market fit is much more than product market fit or than anything else. So I think and do take a structured approach to investing. What I also realize is that people do get, so because I meet a lot of founders myself, and I in angel invest in companies wherever I like the product and the team. One thing that I find is that people get demotivated when they get rejected. And somehow the best founders that I know don't get demotivated on rejection. Because I remember Roman and I pitching. We went to Delhi, Mumbai, and Bangalore. We did a 15-day trip, and I think we ended up pitching uh, almost 100 investors. This is during our seed round, Mukul, when you rejected us.
Yes.
But
Yes. Unfortunately, I remember that very well.
I'm just kidding. No, but I remember that was, in fact, your meeting was our third or fourth meeting. So, I mean, why do founders get rejected? I mean, it's okay. You pitch the next investor, you figure something else out. You make sure that if there is feedback that you received about something, so in the next meeting that you go to, you work on that feedback. If there is particular question that you could not answer, you read, you figure out, you talk to your mentors, you figure out what the right answer to that question is. And next time when somebody asks you that question, you give it with more clarity. See, at the end of the day, in early stages, and if there are, I don't know whether we have more early stage founders here or we have more late stage founders here. But I think in early stages, what is more important is that clarity about what you're going to build and how you can convince the investors that your team is the best team to crack this particular problem. I mean that's, and don't feel bad on rejection. Just keep trying. I mean there are so many investors. I mean, uh, if you really want to build something and you need the capital, then and figure out maybe the, so for example, there was this founder yesterday, I don't want to name him, he just closed a round and then he pinged me that he has another term sheet for the next round. And I advised him that, boss, you first build something and then raise your next round. So I think yes, fundraising gives you security. Yes, it gives you peace. Yes, you can, you have capital, you can attract the best talent, you can build good products. But at the end of the day, what's really also important is to realize that fundraising is just one of the 15 things you have to do. You have to get the talent right, you have to get the product right, you have to hire a sales team, you have to hire a great design team, you have to set the mission of the company, you have to make great internal processes. It's one of the 15 things. So sometimes people start acting as if it's it's the most important thing. Or yes, it's important, but it's one of the, I mean, at the same level, I would keep at least 10, 15 more things. But those things don't get enough attention. For example, people don't spend enough time reading. People don't spend enough time working on traction. So I think, yeah, I mean, these are the points.
Got it. And Gaurav, for a fresh founder, and actually you asked the question whether most of the founders are early stage or looking for growth stage capital. My understanding is most of our audience are founders who are in very early stages and looking to raise either a angel, seed, or early rounds of capital. So now for a founder who is, let's say, raising capital for the first time, earlier there used to be a very clear track. You raise an angel round, you raise a seed round, then go for Series A. But now all of them have sort of gotten muddled. And as a first time capital raise, you can raise any of those. It could be an angel, it could be from a seed fund, it could even be from a mainstream VC fund. So what would your advice be to founders? How should they approach their first capital raise?
Don't get VCs in your seed round. In your angel round, sort of the first round should be sort of like the friends and family plus angel round. I think somebody told me this at some point, and that advice stuck with me. If it's a large VC fund, if it's a Series A VC fund, then you should get them for Series A. If it's a Series B VC fund, then you should get them for Series B. Because if the investor coming in has written such a small check that for them it doesn't matter, then there is no upside for you to take money from them unless you got a good rapport. So see, if it's good chemistry, then you choose whoever you want to choose. Then you don't think angel have VC or whatever. But what I feel is that in the first round, if you get some angels, if you get people who will give you time, and so I have this interesting theory that you need to figure out the right amount from the person, and for that amount you kind of will get their time. So if from a very large VC fund you raise 500k, I'm not sure how much time you're going to get.
Right.
But if from an angel you raise 100k, that angel might give you even a couple of hours a week. So I think initially it's about mentoring, it's about getting the small stuff right. So my preference, unless you build a rapport, is angels, is and then probably in the next stage you get an early stage VC, you get Y Combinator, you get Surge, you get investors who do $1 to $2 million checks. But the first 500k round, or let's say 300, 400k round, preferably should be from angels.
No, I love that framework, Gaurav, where you are saying it has to be a meaningful skin in the game for the investor, or the chemistry or excitement from that investor has to be so much that you feel like they are personally committed, even though the check size might be small for them. Yes. And this is a good segue to how you went about raising your angel round, because we have an all-star cast of angel investors in an academy, from Bhavin to Kalyan to Sujit. Did you know them all from before, or how did you go about reaching out to them and convincing them to invest?
I mean, again, as I said, I think somehow I don't get demotivated when I got rejected. So I think Bhavin must have said no to me, or must have said that we'll meet later at least 20 times over a period of 6 months. But I still kept chasing him because I knew that he's a great founder who has built some iconic products and companies, and I want to learn from him. And in fact, he was also my first employer. So I knew more about him because I had seen firsthand how he built his companies, how the culture was, how training happened at Direct Eye. And I was like, I want to learn from him. And I kept chasing, my family was asking for a trip. So I strategically planned it in a way where I chose the city where Bhavin was. So I think he was in Dubai that time. And I told my parents, let's go to Dubai. And somehow I was hoping that he gives me finally a meeting, because when he comes to India, he's busy, etc. So I pinged him that, can you meet for 15 minutes? And maybe after 15th, 16th time or something like that, I think he said yes. that, okay, let's catch up after my squash game or something like that. And that meeting lasted for 1.5 hours, where he agreed to come on board as a board of director and give time. And I think uh, uh, from that day to today, he's one of my closest friends and mentors. And um, I have learned a lot from him. Like he's one of the coaches that I have learned a lot from. And this is the advice to most people, that uh, I mean, literally, for me to even get coaching from somebody, one, had to know that who that person is going to be, and second, I had to literally fight very, very, very hard to get their attention. Now, whether it's Kalyan, whether it's Sujit, whether it's Bhavan, whether it's Vijay of Paytm, fortunately, I got a lot of angel investors, and they were one message or one call away. And if I could not call them, I could message them, and I would know that maybe in a couple of days they will get back, etc. And I think that helped a lot, because the best part about these people is that you just ask them one question, and they will give you a no bullshit reply. How do I do this if I'm stuck in a problem? The best part about these people is, because they have scaled, like at that point they had unicorns and they had scaled their companies, etc. You send them one question and you'll not get options. They have done that. You'll get that one reply.
Right.
Just do this. So I think, and then one of the things when getting these angel investors and mentors is, and this is not a hack per se. This is the only way to go about it is, if they say something, then you better deliver on it. So let's say if I went on and asked for X advice from someone, and when they gave that advice, I made it a point that I used to follow that. And a week later, I used to send them a message that, hey, this is what I did. Because see, at the end of the day, when you take somebody's advice, and this is how you make mentors. Tomorrow, you cannot go to someone and tell them that, hey, please be my mentor. What you need to do, even if you get an angel investor, if you want them to be vested, they will give you advice the first time. But the second time, they will only give you if they got the ROI of the advice on the first time. And to them, the ROI is not money. To them, the ROI is that the advice helped you. You took it seriously, and you took it seriously, and you worked on it. And when you work on it, that's it. So I made it a point. For example, if Bhavin told me to read a book, I used to read that book within the next 72 hours, and I used to send him notes from the book. And that sort of made his giving advice worth it for me. And then the virtuous loop starts. Most people do not follow up on advice. They start applying their brains that, whether this is worth it or not. See, my logic is that I usually don't question if somebody has given me advice. I usually do it. What's the worst case? If it doesn't work, okay, you backtrack, you go back to what you think is right. So I think this is something that I keep telling people, that you got to chase them. Don't irritate them too much, but like until a reasonable point, you can keep following up, etc. And second, even if they come on board, they are not going to be your mentors unless you give them ROI on their mentorship.
Yeah. No, this is very powerful advice, Gaurav, not just for founders, but for any of us who want to have strong mentors and coaches. Just closing the loop and sharing what you did with their advice and feedback. I think that's a great takeaway. So moving on from angel to institutional round, which you mentioned that, okay, start with an angel round and then go to a seed fund or a larger VC fund. How do you reach out to them? And you mentioned you had 100 meetings. So was it like you cold calling, pinging them on LinkedIn, going through referrals? And for again a young founder, how do they reach out to VCs?
I mean, advice number one, and it's very straightforward, and nobody is going to give you this, but I think it's really important for you to be in Bangalore. I mean, it just makes things easy. Now maybe not so much because the meetings are happening remotely, but when we were doing things, I think staying in Bangalore was super important for us. Um, I think what generally happens is that once you get strong angel investors and you're building something really good, usually the angel investors will connect you with few people. But depending on how you do in those first two meetings, they're going to connect you with other people. Because believe it or not, it's a small ecosystem and everybody talks to each other. So as soon as you do your first VC meeting, that VC is going to call the angel investor who referred you to that VC and give you feedback. Give that investor the feedback. And if the feedback is good, then that angel investor again is vested to set up more meetings for you or to help you, etc. And many people go for these meetings unprepared. And one simple thing that I advise them to do is make a list of 100 questions that you are going to be asked, and be at least clear. If you don't know something, if you don't know how you're going to monetize, then say, I don't know, we haven't decided, we haven't planned, but these are the 5 ideas I currently have. These are the 5 things we can potentially do, but we haven't started working on it. At the end of during the pitch, the investors are not looking for all the answers. I mean, if you had all the answers, you would not be pitching to them. Yeah. At the end of the day, investors are looking for clarity. Investors are looking that is this person going to crack this market or build a product in this market that is going to be significantly better than anything else that already exists, or significantly better than anything else that others are building. So I think and what people forget is that, like, I mean, I keep giving this advice to many people that, note taking is something that you should always do. And before every meeting, even till today, before my meeting, I write how the meeting is going to end. I have an agenda that this is my best case outcome for the meeting, and these are the 5 questions that are going to be discussed, and this is what my reply will be. And most people don't plan. They just maybe think about 5 questions that they are going to be asked. They prepare them. They don't plan the entire conversation flow. They don't write that, these are the 7 questions I'm going to be asked. And if I'm going to be asked these 7 questions, maybe let me call my angel investor and discuss these questions with them. So I think people and this is company level, this is fundraising level, this is every stage. People over optimize on execution and under optimize on planning. And I have this philosophy that I keep telling people, which is sort of this, that write the script before you shoot. So, how Christopher Nolan makes movies, and some of his movies are the best movies. And, I sort of tell my product team and, my leadership teams, etc., that, that sort of movie, Interstellar as a movie, is a product. And it's one of the best products in the category. And or Inception or Dark Knight, these are some of the best products in that category. Right. For years and years, research goes into this product and a script is written. Every single thing to the detail is planned. Now, maybe while shooting, 30% of the stuff, 20% of the stuff might change, but 70, 80% of the stuff remains the same. Similarly, when you're going for a meeting or when you're building a product, people don't write the script. And one thing, I mean, I wrote about it in my blog also, but one thing that I keep telling people is, before building, just take 3 days to write a 50-page story, and not a deck, not a business plan. Annual operating plans are a work of fiction. Not that. 3-page story on what your product is going to be, who is it going to use, or even, let's say, an investor meeting is happening. Why don't you just write the script of that meeting yourself? It will give you so much clarity, and it just takes 2-3 hours of that alone time where you sit with yourself, ask questions, and know that these are the questions you won't be able to answer. And then you call up your angel investors and ask them, hey, can you advise me on these questions?
Right. I've heard a lot of founders talk about preparing before the pitch, but I've never heard it in so much detail in this level of thoroughness. It almost reminds me of Sachin Tendulkar talking about him visualizing a century every time he walks out to bat. So it's just amazing the way you described it just now. Gaurav, one other question for founders is how much should I raise? And obviously there are two parts to it. One is how much to dilute. Should I solve for dilution? Should I solve for capital raise? And second, also if I go out with too big an ask, I might scare away investors. So how to think about that?
I think you should solve for peace of mind. You raise, let's say X is the capital in your bank or X is your runway, and you get peace with that. Raise that much. Now, for some founders, I am a paranoid person. I don't get sleep if I have less money in my bank. I need runway because we do a lot of creative and innovative stuff. So if I just have 12 months of capital remaining, then I can't innovate at the speed I have to innovate. So I always usually keep a runway of almost 30 to 36 months at any point of time. मतलब 18 तो मेरे लिए zero है. So if I have 24 months, and by the way, this is very unconventional advice, and I mean, if it works for me, I'm not sure if it works for others. At 24 months, I get so paranoid that I have only 6 months left. Because 18 is sort of zero for me. Because see, at the end of the day, the survival of the company is most important. You cannot let it fail. You have to keep compounding. If it fails, you'll start from zero. You have to figure out a way. And because you are, unless you are, I mean, we never copy ideas. Every single product that we have made ourselves was, whether it's Graphy, whether it's test prep subscriptions, whether it's the coding new subscription that we are launching, they are innovative in their own sort of way. Now, when you have to, if you have to copy an existing idea and you're clear about, this is what the CAC is going to be, this is where you will spend the money, this is what your gross margins will look like, then you raise maybe, for let's say 18 to 24 months. But if you do not know and you have to pivot and you have to find a product market fit, then you are better off raising more money.
Right. No, I actually would completely agree with that. Even as VCs, oftentimes in our portfolio companies, we advise them to have at least like 2 years of capital in the bank when they are raising. But I've seen the power of having 3+ years of capital. It really gives you that flexibility to go for new optionalities, make bold experiments versus just executing on a linear path.
I would recommend 4 years of capital. I think it's good.
Yeah. And actually, we are running out of time, but just a couple of quick things. One is, again, you would have seen when you are out trying to raise capital from institutional VCs, oftentimes VCs will sit on the fence, and there is always that temptation that I like this guy, I like what he's doing, but let me wait for some more time and see some more traction, some more execution. So how do you push them to pull the trigger? How do you push them to get over the line?
I don't raise from VCs who don't have conviction. If VCs need conviction for other people to say yes, I will not raise from them. I mean, we are in a market where there are enough investors. Why do you have to bring someone on board who solely doesn't have conviction in your product or your idea or something like that? Unless, again, as I said, rapport hai, chemistry hai, and you really want to get them, that's a different thing. But usually completely avoid the investors who are not giving you a direct answers. I mean, I have been fortunate enough to have investors on my cap table and the new investors who say, we are going to lead it. This is going to be our offer. We don't care who else will come. So you are, I mean, how do I put it nicely? But don't work with people who suck your energy. I mean, people who sit on the fence and keep sitting on the fence, etc., are energy suckers. You have to work with people who have conviction. And conviction nahi hai to unko bolo sir ya to aap haan bolo ya mana karo. I mean, you need to push them that, see, this is my fundraise cycle. I have 15 days. Either you say yes or you say no. And you have, if you're not inclined towards one completely, then just pick one so that I can move on. I don't have time to wait until you build your conviction to raise. If you want to come, you have your conviction, we'll get you. Otherwise, let's move on. Life is too short.
Right.
And
makes sense. And just
trust me, my attitude is not like this today. You know me. My attitude was like this in 2015.
Yes. No, I agree. And I think this does help VCs also get over the line versus a founder who is constantly chasing you. You almost feel like what's going on here. So I completely agree with you. Gaurav, just lastly, what are some of the common mistakes that you have seen young founders make when they are trying to raise capital, and which mistakes would you advise them to watch out for?
I mean, the number one is obviously planning, clarity, etc. The other one is that, and this has happened 3-4 times. Usually, when a founder gets a term sheet, let's say they pitched out to one person, they got a term sheet, etc. I kept saying, can you please meet more people? And yes, we live in a market today where investors at early stage put this pressure that sign today, or sign in 1 week, etc. We found you first, etc. My advice to only, especially people who get a term sheet, is that please, please, please meet people. Do not, I mean, money is something, trust me, that you can get investors who sort of will be your co-founders for the first 3, 4, 5 years. I mean, at an early stage, an investor who's coming on your cap table, who's coming on your board, institutional investor, is like a co-founder. So just ask yourself, the litmus test is, would you have gotten this person as a co-founder?
Right.
And if the answer is yes, then get that person. Otherwise, unless you really need the money, please avoid.
Awesome. Perfect. Thank you, Gaurav. This was super helpful and very, very
and thanks a lot,
actionable
Mukul,
insights.
for being one of our early supporters. And I mean, really grateful to have you on our board, and really enjoyed working with you and Saif since 2016.
Really kind of you to say that, Gaurav. The honor and the excitement has been all ours. So thank you for giving us the opportunity, and thanks for taking time out for this chat.
Yeah, thanks a lot.
Thank you. Thanks, Karan.
Thanks so much, Gaurav. I think we could have done this for much longer, but I think that's super useful. And I think even the founders love the open advice.
Thanks.
And thank you guys. I think it's super session. And like the last one, just putting a link for a survey just to give feedback from the audience would be great if people could sort of respond to that. Guys, we'll just move to the next session. So thanks again.
Thanks a lot.
Thank you.
Thanks, Mukul. And the next session is going to be led by Narayan, who's the Chief People Officer at Excel. And I think we also have Shuvi and Anirudh joining for that. Narayan, I will hand it over to you. I think as we're getting Shuvi and Anirudh to kind of join, I will leave it to you to sort of take it forward.
Wonderful. Thank you, Karan. Appreciate and thank you for giving me the opportunity to host and share our learnings with the audience here. Appreciate. Shuvi and Anirudh, I see Shuvi online. Anirudh, I'm sure you're online too and your video is on.
Hi. Hey, Narayan.
Hey, hi. Wonderful. All right. Before we jump into the conversation, we have a interesting conversation today focusing on co-founder and team. And we want to have a candid conversation from both the investor perspective and also from the founding team perspective, so that we get different dimensions of thought for our audience to decide and make their choices of co-founder, and then also how to hire the right team. Before we get into the conversation, I would like to introduce my panel, our colleagues from the industry. Shuvi, welcome, Shuvi. Shuvi is a graduate from IIT Delhi. She's worked with Bain, and she was an associate at Lightspeed. And for sure, after working in a VC, we all had the itch of starting something. So she went out to start something, She was a founder at Uttara Labs, and she had some amazing experience building it. And from that experience, she's back at Lightspeed as the vice president. Thank you, Shubhi, for being part of the conversation and sharing and going forward to sharing your ideas.
Having us.
Our next, my next panel member is Anirudh. I don't think we need any introduction. He's been making us laugh, or rather, my daughters are a big fan of filter coffee. And when I heard Anirudh, then I said, "Wow, okay, it's going to be good." To know from how the innovation and creative industry looks at founders, co-founders, and building a team. A quick background: ex-Wharton, and for sure he spent a lot of time thinking and seeing how to make money at Goldman and at Olo Group, and then he jumped into becoming a founder at Pocket Aces, and for sure clocking one of the topmost videos of what you guys have done in Filter Coffee or Gobble or Dice Media have been amazing. So we look forward to learning and hearing your thoughts on co-founder and team. I think that's the topic which we have today.
Thank you, guys. Great to be here.
Wonderful. So what we're going to do is the structure of a conversation is quite simple. We have a few debates to begin with, and then we'll open this up for audience for questions. So that largely this is done for the audience. So we want to make sure that the audience get the best out of it, because it's going to spend the Saturday morning listening to our conversation. So that's the way we're going to start with. To begin with, I think we all know and understand co-founder disputes have been the #1 startup killer for early stage companies, and for various reasons. Like one said, if we are able to get the right marriage between both the co-founders or multiple co-founders, then the journey becomes much more seamless. So to begin with, I want to ask my first question to Suvi. Suvi, do we really need co-founders?
That's a very interesting question, and I guess as a caveat to everything I'm going to say in the next 45 minutes, just want to put it out that startups, it's very, very difficult to be prescriptive about startup journeys, given that every success is an outlier in general, and it's hard to extrapolate or pattern match too much. Of course, we will still have some high level guidance or preferences given what we've seen, but we're still talking about the top of the bell curve. But every journey is unique, so urge everyone and encourage everyone to really think about what's right for them versus what's a universally right answer. But having said that, I think in the early days, when you have little else but this shared belief in a vision that you're going to land yourself into a few years from now, it's good to have more people believe in that vision before you've sold it to more employees or investors or your customers. It's just good for your own personal motivation and momentum that you have 2 to 3 people who also believe in it with you. And I think that's the biggest value add of a co-founder in the early days, because over time you can always add functional experts for whatever gaps you're trying to fill in or roles you're trying to fulfill. But this emotion management and psychology management in the early days is, I think, where a co-founder can play a very, very big role. It's essentially like having a sounding board with equal skin in the game. And so again, there's high trust, high alignment of motivations, hopefully high values alignment that can actually help you navigate the 0 to 1 journey. So I think to that extent, it's valuable. At the same time, I've seen companies with solo founders who've ended up, creating very large outcomes. I've seen companies where instead of having a co-founder, a founder decided to split up the other 50% between 5 other people, give them 10% each, right? So there are many different ways of composing your early team. No right answer, but in general, good to have more people believe than be the solo soldier on the journey in the early days.
Wonderful. Thank you, Sived. I think that's interesting. So, which means largely your co-founder need to align with the vision, and support mostly during the emotional needs and requirement during the early stage. For sure, there's going to be a lot of things which is going to go in the background while building. Now, moving on, Anirudh, now let's move on to just check. Now, interestingly, we have seen co-founders. One of them will have to be a CEO, right? And many a times, power is something which gets to people. Either it's money, either it's the responsibility. Now, how do co-founding team decide a CEO, or is there an investor's role in making these decisions?
Yeah, I think what Shuvi said, Narayan's very, very correct. There is no one road to success, right? And everyone has a different path and a journey. And I think having that sort of confidence and a little bit of perspective to step back and say what's right for us right now, I think is very important. I definitely think being a single co-founder is extremely difficult because of the psychological journey that Shuvi mentioned. I think how do you pick a CEO? Actually, I always, at least the way we run our company, we think of ourselves as equity holders and as management team. Those are two different hats because they have different points of view. And I think the person with the most amount of clarity, single-minded clarity on vision and single-minded clarity on where we're going next should play that role. Now you can, one of our investors is Axelor, where I've had the pleasure of spending quite a bit of time with Chris Gopalakrishnan right now. And Infosys, they cycled through multiple people, became CEOs over time, right? So I think the key is who has that clarity right away and who can get the job done there. And different people could be that person over different stages of a company. At the beginning, it could be the person who has the most, understanding of the 0 to 1, of understanding that kind of getting that product market fit. When you have that fit, someone else could be better at scaling the company. It could also be the same person. But so I think that looking at the CEO role or getting attached to a C title, I always say, it's a very, very bad idea. It's like, in Lord of the Rings, when you get the ring, Gollum, you become Gollum, right? So I think that it's really important not to fall into that trap. And different people can do that role. For us, at Pocket Aces, we've actually never had a CEO. So we did not actually use that structure. And so to Shuvi's point, everyone has their own perspective and viewpoint on how we can do that. And it works for us because of the arrangement we have and, the decision rules we have and the trust and years of trust. I mean, me and my partners have known each other, for almost 2 decades now. I mean, that's how old we are. So that most of the people in the audience may be born only 2 decades ago, but that's a deep trust relationship. So I think if you have that, then you can chart a slightly different course and a path. But yeah, that's how I would say you should pick. And you shouldn't think that just because someone is CEO today, you can't be that person tomorrow. If you show that vision and you show that value plan and you show that ability to execute, there's no reason you can't be that person. And if it's the other person, I think you should just say, okay, this guy has it right now. Let me support and find a way of getting to that end goal or whatever the goal is right now as quickly as possible, because startups are all about speed and growth, right? So till that's your only advantage as a startup today. I think there's really compared, any big company can copy your product. Any big company can really incentivize your team members. There is actually nothing you have on paper except speed, because I guarantee no big company can move with speed. And that's true for all. As you deal with Google and all these companies, you must have seen people are now saying, oh, the Google Play Store bills are not being approved quickly, right? And you thought all this while Google was a cool startup, but they're a $1 trillion company, right? So they take time for different things. So I think your advantage as a startup is speed. So rather than wasting time on arguing, have one clear decision point and then just move forward.
Wonderful. No, thank you. That was insightful, starting from decision making and equal partners and stakeholders, and clearly having clarity of thought. Very amazing. Now, moving back, Now, for our early stage founder, let's say I have an idea, and if I have to go back and look for a co-founder, is there a process? Is there a rule book for me to go back? And this is largely to both of you, Shuvi and Anirudh. How will I go make my decision in looking for a co-founder? What are those things that I should look for, or what should be the process?
There's a lot of material on this on the web, but maybe I'll crystallize it to the two things that matter the most. I think one is just value alignment. And this is in terms of, I think it also plays into what you're solving for, what are your long-term motivations, and then on a day-to-day basis, what are your decision-making principles and philosophies. So I think just being very aligned on those values helps you also trust somebody else with their judgment. Right. So even if you're looking at different functions, you don't have to get involved in everything else your co-founders are doing, because you know that you're aligned on the basic decision-making framework. So values is one big one. The other one, I think it's a bit harder to optimize when you're early on in the journey, but I feel if there's functional complementarity between the team members, that again sets the company up for success. What I often see, and this is something I did as well, you get together with friends because you're like, these are very smart people, we can work together, let's just do it. What you don't realize is that I'm just getting, two more of me, and three of us are going to build a company, and that's hard, because you'll just have a lot of conflict because everyone thinks that I'm the expert on the same thing. And then there will be very clear gaps in the team in terms of what your collective weaknesses are, right? So I think if you optimize for just completeness of the team, but with a shared value system, I think that really sets you up for success in this journey.
Wonderful. And Anirudh, your thoughts?
Yeah, I mean, I think value system is very important, and I think in fact, we did it after a couple of years of starting the company, where we actually wrote down some of those things together. Where my partners wrote down some values themselves, and I wrote some values, and then we saw, okay, this is where we align, and luckily we had a pretty high alignment on that. I think number one, I would say, is trust is really important, because regardless of how much money you're making, regardless of what share in the company you have, regardless of what your title is, it's not going to matter at 3 a.m. when you're sitting with this person. And I think that very few things will substitute for that passion you feel at that point. And I think that's distinguishes any good team from another, right? Why do certain teams in sports outperform, with very good talent on both sides, right? And then just because of a rearrangement of a few people and the manager changes, right? It's because they give that extra, on the 94th minute, they're still pushing. They're tired, but they're still pushing, right? And I feel a lot of great success comes, it's like research, right? Like the first 2 years or so, whatever time you take to find product market fit, I feel is like research. Every day you're going in, you don't know what you're going to see. It's likely going to be bad because nothing is working. You're trying different experiments, and your rate of experimentation will dictate success rates. You don't know that though. So you keep going in, and every day you get frustrated. So you need that trust that the other person is going to pull their weight. They're going to be an A-team player, and they are also, so to Shuvi's point, that functional expertise is helpful there. But just that desire, the same desire as you to do something, and they're not going to, let you down there. I think that trust is really important. It's actually a lot like a team. Like if, just to give I give a lot of sports analogies, but like as a football player, if I'm pulling in the cross, I need to make sure that the forward's going to hit that ball in the goal, right? Like that level of trust that they're going to be there. They're not there yet, but when I hit the ball there, they're going to be there. That trust comes over time. And I do feel that a lot of guys who pitch us, even just angel investment and advice, there's too much speed dating that happens, right? And speed dating is not a good, good driver of success in general. You don't know what you're going to get, right? I think if you've worked with people before, I think that is very helpful, because you will have a sense of what happens when stress arises, what happens when the going is good. And I always say there is no problem of all these power issues and all till going is bad. The power issues come when the going gets good. Like nobody cares if you own 50% of 100,000. Like they're not going to care. But if your startup starts looking at 100, 200, $300 million, then suddenly that extra $1 million starts playing on people's mind, or other people tell them that. So I think that trust factor is really, really important.
Wonderful. And I think to sum it up, it's more of a shared vision, trust, decision-making matrix, and collaborative thought process of one collective vision of how to achieve the end goal, right? And while we understand, these are all critical and important, as humans, every solution can be reached in 4 or 5 multiple ways, and this gives rise to conflicts. How do founders resolve conflict? Now we understand, yes, there are going to be decision-making matrix. I'm going to decide on technology. You're going to decide on market. This is always going to be a clear, illustrated expectation setting. While human mind has a different way of thinking and working. So Shubhi, from your experience, from the investor perspective and from a founder perspective, how do investors look at resolving this conflict? One, and the second thing is, while you were a co-founder or a founder, how did you go back and resolve this conflict?
Yeah, I think in India, our fundamental problem sometimes is just conflict avoidance in general. And also the fact that, loyalty in our heads almost means blind allegiance to anything this person is saying. So I think step one is just surfacing those conflicts to begin with and having that conversation, not keeping things in your mind and letting resentment or grudges build up. And once you have that trust layer to be able to have these conversations, I think conflict resolution is very similar to how you resolve conflicts in any other domain in your life, right? Whether you're in a job, or whether you're you're in a conflict with your friends or whoever else. So I almost feel like as long as there is a basic alignment on principles, any conflict can be broken down into what are the areas of dissonance and what have we agreed on in the past that we can use to come to a decision here. But I think step one is just having that conversation and being fully transparent and upfront about it.
Yeah, Anirudh, your thoughts around?
I love conflict, so it's I understand what she was saying, because I found that as a big problem in hiring here. One of the questions I ask in interviews is, hey, can you give me some feedback on my performance in this interview? And literally every single candidate will say, you did really well. I said, okay, but can you give me some rating? And of course the rating is 8 because they want to be higher than 7, right? But then I have to pull, they believe something, right? And but they don't say it. So I think that's a cultural divide somewhere there, and I think that's changing. But it's I think this new generation of startups has that ability to change some of that culture. I think that having some sort of understanding of how to make those decisions is important, and having an understanding of when a decision needs to be made is important, and whether a decision is irreversible is important. Like, if a decision is not that important, or like it's not fundamentally going to break something, why are you spending an extra half an hour wasting someone's time, or like making them go through the hoops and that, right? So I think that thoroughness, and asking for thoroughness versus asking for being anal versus asking for power, I think those, you need to just understand your own mindset there. But other than that, I think conflict is a good thing, as long as you know that it's not a personal problem, and as long as there are certain whatever objectives are defined, and just have a time to make a decision. And one of the key things that Sequoia has as a as a guiding principle, which I really like, is called disagree and commit, right? I may not agree that Virat Kohli should open the batting, but if I'm in his team and then we decide that, now I can't say after the match if we lost that, no, I told you, no, you should have batted number 3 or number 4. Like, okay, we lose and the captain learns then. Whoever was making the decision learns, they're on their own learning journey. I told you so has no value, right? You're actually just irritating people and actually causing morale to go down. So I think there's a bit of self-discipline that everyone has to learn that. And people do learn it over time. And I think I've found, at least my journey, I've been lucky. A lot of we've acquired or acquired 2-3 different companies now. and most of those founders have worked with us for a significant period of time and continue to work with us and alongside us. And I found that they have that ability to disassociate personal feelings from what the decision at hand is. And so there are a lot of conflicts, and good teams will always have conflicts. If you have no conflict, I think that's the opposite. You have to worry that something's wrong. So yeah, just have a time, because I think Shuvi said something earlier, which is if you have a competence overlap, then you go in circles. So you'll often see that you start with arguing position A, then they're arguing B. 1 hour later, you're arguing B, they're arguing A, and then you're going in the circle and you're never ending, because, and then time kind of makes that decision for you. So I think just having some framework is important. Like you don't have to pull it out, but just having some of that is important.
Wonderful. Conflicts are important. Now, this is something, which I've heard during my conversation with multiple founders, is that, hey, anyhow, at scale, co-founders' role will be transitioned, or they will hire a functional expert to come in and a CTO or a CEO. Well, I have my idea and I can run this company until I find the product market fit and scale and growth. Why can't I hire my co-founder as an employee? Any thoughts around it? Or is there an investor push to have a co-founder?
I think irrespective of what your investors are pushing you to do, you should not listen to them too much. They are one source of input, like you have hopefully 20 other sources of inputs. And I think the founders should eventually always take their own calls. We are all resources to help founders, take the right call, but not beyond that. So I think that's one. The difference between a co-founder or an early employee in my head is just skin in the game and risk tolerance. Because an early employee will, give you a shot for 6 to 12 months. If things are not moving at a pace he expects, he is more likely to just jump ship and go to something more exciting. A co-founder signs up at least for a longer journey of figuring this out together, even when things are going sideways. And that is what is the higher equity stands for, essentially. And that, I think, is the core difference between a co-founder and an early employee. And so I don't feel like they're the same roles really. As a founder of a company, I think what a co-founder brings to the table is the same level of commitment, hunger, ambition, risk tolerance that I do. Whereas with an early employee, it's still a little more transactional. I mean, ideally, they're also as bought into the vision and they're as hungry. But they're not obligated to stick it out if you're not able to get to a certain place by a certain amount of time.
Wonderful. Anirudh, your thoughts?
Yeah, I think hunger and desire and the kind of thing that keeps you up at night is different between those two roles. I think, early employee is extremely important, and which 100% will have to share your vision. But what may keep them up at night is their functional expertise on what they're working, right? So something is not working in a particular piece of code that you written, or something is not efficient. But for the founder, there is other concerns in general, right? They're trying to, they have multiple levers in their hands. So I think, and as your company grows, your early team member will become almost like a founding team member, because they're going to get more levers in their hand too. So actually that's a nifty way of kind of thinking about the kind of stress that you deal with is different. They're both stressed, but the kind of stress is different. So I think that distinguishes the two. And of course, should we put it very well, right? So people work with you. There's a saying in the Hindi film industry, right, that मैं passion के लिए काम करता हूँ, right? But that means that in the film industry, that means I'm not getting paid. Right. So I think, the first two people or the first three people, whoever has that significant equity stake has better risk tolerance and should be taking less salary, and really, really making sure that the equity value is maximized and the employees making sure their functional value is being delivered, right? There are different outcomes there in some sense. So that's it. And I think after that, I think your self-starting people don't worry so much about who is the co-founder and who's not. And that power balance, I feel, at least in our case, I've felt that really started changing around the 100% mark. And, because the 101st person doesn't know you personally. And so that's something that we really worried about, that, okay, they shouldn't feel that way. Right. And the slide to the 8 to 5 culture must not begin at any point. So you have to watch out for that. But that's it. That's the only difference, I would say.
Wonderful. And like you said, from the co-founder perspective, I think there's a lot of transition in terms of what we look for: shared vision, purpose, trust, decision making. And now hiring the first employee and the first team member is also as critical as a co-founder. Now coming back, some of the founders, find it hard. Okay, when do I need to hire my first employee? While I have my founding team available, when do I need to hire? Any thoughts around it, or it's largely driven on purpose? Shuvi and Anil.
Yeah, I think in general, org in startups should be role first and not people first. And so think about what are the key gaps in the current team with respect to what you want to achieve with the business, and then start, putting people or names to those roles. At the same time, I guess as a founder, you have to be thinking 3 steps ahead, and what will I need 6 months from now, and start looking out for those people starting now, because it sometimes just takes that long to close the right person. But in general, I would say, as long as you have the philosophy of, what key roles am I trying to fill versus, just designing that org chart, I think you're in a good place.
Yeah, I think a lot of it comes down to resources and need, and availability of that talent and your ability to convince them. So really, at least the way we did it was, we had designed an org chart of us in a year or 2 years. And then we said, okay, there are 20 positions here, but we only have 2 people. So then we said, okay, this I can do as one of the founders. And then, this is a critical role where we need this functional expertise. Usually the first employee will have to have some strong functional expertise. And to, again, put it in from a sports analogy, has to be in your top 11. Like, they have to play. Like, they have to they have to be a game changer. Like, they have to bring something to the table. So they generally, unless you're one of your, like, say this is where it's a little different for different companies, but if you have 2 developers working together, the third person can very well be a sort of a business or anything officer sort of person. But that's usually unlikely. Usually, the first person has to be someone with functional expertise. So in our case, because initially with the huge impetus we had on the creative side, we hired someone who is a writer and a director, now a famous celebrity on the internet. So, that was the first person we went with, because we felt, okay, because we have limited resources, we cannot hire an editor, and it doesn't like we had no money at this time, right? So we used to work out of a cafe, and so we're like, okay, this guy can do 3 jobs. So while I'm doing 10, the other guy, my partner Ashwin, is doing 10, this guy can do 3 jobs. So I think that's how you make that decision. And the same thing, once, after that, we've run different divisions and startups inside of our company. In some ways, we've made it the same way. Who's really, really critical to help us to get from 0 to 1, and we don't have.
And one of the difficulties early stage founders or startup space is attracting talent. Now getting into more tactical aspect of it. How do some of the founders, from your experience, go about building a great practice of attracting talent? Because they are competing largely with great brands and big startups with big paychecks and things like that. And while we understand founders have a need to ensure that trust, collaboration, decision making, shared vision, all of these things are important parameters to meet with, along with functional expertise. So what are some of these aspects, Anirudh, you've looked at when you're looking at talent, and how have you gone and hired your first 15, 20 people while you did not have a brand or enough resources to go back and hire them at an expensive price?
Yeah, I agree. I think talent is, and we firmly believe that's, the bedrock of any great company is the talent, right? People build products, and people build services that help you get profits tomorrow. So I think that getting that right is really critical, and it's actually critical through the whole journey as well. So while it looks difficult on day zero, it's also difficult later because the quality of that talent has to be important. Because usually early you can find someone who's a little more of a self-starter, and you will find that the first 10 guys are able to, they are attracted to the opportunity because it's young, it's fast moving, they agree with you. But cut to a little later, which is 100 employees scene, that can change. So that's an important thing. The first guy is always hard because you have nothing. You literally have nothing. So all you have is your dream and your ability to treat them well and fairly, and they know that they can rely on you to provide those other things that they don't have to worry about. So I think that the ability to sell your vision, the ability to communicate it also, and the ability to make it seem like a place where it's going to be fun. I think that's a underrated element, right? Like, you're going to spend a lot of time together. They like the other person. If you don't like them, like, they're going to run away home first time, first chance they get. So I think those things are really important, and making them feel needed is important. And then you have to ask yourself a question like, why would someone leave a job where they're getting paid a good sum of money? They have an established way of working, and maybe even an established a reputation that they've built. Why would they leave that to join you and you have nothing? You really need to think hard about that question and have that pitch. Like, we had written that pitch actually. So we had a script written, so that
Very nice.
you don't, because otherwise you get nervous sometimes. You're like, oh, this guy's making so much money and so and so, and you'll be surprised. A lot of people actually join you. You'll be shocked at the kind of people who join you. And we've been very lucky on that count, and you realize people are looking for different things. So I think also ask them what they are looking for, because that value alignment that we talked about will not happen unless you know what they're looking for. And the best salespeople listen. There's a model of the sales guy which is shown by the media, which is they keep talking all the time, and it's kind of like the Wolf of Wall Street, where they're like thumping their chest. I mean, the best bankers, the best consultants I've worked with just listen, and they're usually very patient. So I think just listen to the other guy. You'll know whether you can offer that bridge and you can work together. I think that's it. Once that alignment is there, I think you'll get the first few guys.
Interesting. So which means great ability to tell story, connecting it to the shared vision, and being a good listener are some of the tools which the founders can use to attract the right kind of talent.
Narayan, if you allow, I just want
sure.
to add that some of the best founders I've met, what I love about them is that they're always punching above their league. So, a lot of people just argue against themselves and will not reach out to certain people thinking, acha, ye kyun mujhe join karega? But I've seen, the most ambitious founders actually, figure out who they want in their team and then just go after them, no matter how many months or years it takes. Like, I've known people who hired or who got hired after 2 years of the founder chasing them. So, again, just being super patient and like Anirudh said, listening and trying to understand what is that person solving for in life, and then creating that environment for him inside my company, I think is very, very important. So, just aim for the best you can get. Aim to always, have people smarter than you on the team, especially the first 10, 20 people are really, really important. And don't hold yourself back. Don't discount yourself or your selling abilities is the only other tip I would add here.
Wonderful. Now I think we're getting, moving on, we're getting some interesting questions from the audience. Now, one of the member would like to know, let's say founder agrees for the vision initially, after 1 or 2 years, there's a conflict of vision, or other co-founder does not believe in that particular vision. How to deal with it? Should be from investors and from Anirudh, your experience of of how you're managing it and in keeping the flock together and things like that, and those experiences would be of great help to the audience.
Yeah, I think this question is, what is their confidence and their their surety in not believing, and are what they're saying actually correct, right? So if you're betting on a certain market and that market clearly is not playing out, the metrics are not right, market always wins. Market and timing you can build the best team, but if you have the marketing timing wrong, the product will not work, right? But the good teams often change products to fit better markets, right? So this is this like reflexive thing. But so I think that, yeah, if they're not believing the vision, they should discuss it and see actually whether they should change the company's vision. And maybe the other person can, if they're actually a true partner in that business, can change the trajectory of that business. And yeah, that's what I was saying earlier. Maybe they then become the primary driving force. Whether they want to call themselves CEO is a different thing, but they present that plan, they take that forward. If they don't, they leave. I mean, they have a huge amount of equity. Anyone who doesn't believe and is holding equity is basically an asset which is with infinite life, right? If you don't believe in the asset's life, why are you holding it? You should sell it, right? That's the simplest way I think about these things, right? It's a slightly financial way of thinking, but people with the longest dated holdings in a company should be the people with the longest dated belief in that company, right? That's how equity holders work. That's what I'm saying. Your equity and your management roles are a little different. Sell your equity, then you're then working as an employee. If you don't believe the vision, you leave, you join another company, and your board and your investors and your co-founder will find someone else to solve that problem. So that's not an issue. And if you are that person, don't worry. Like, you're doing the right thing, by bringing that up, and you could either potentially change the fate of that company, or you are at least gotten out of it and you can do your own thing, and you've actually set that other company up for success in many ways, rather than causing this lack of belief, which causes that cycle of negativity can kill a company for sure, right? And it's like seeing parents fight, where in an unhappy household, you don't want that. If they have a resolution mechanism, that's much easier. And I think so you should just take that out right away.
Wonderful. Shu, your thoughts?
Yeah, broadly aligned with what Anirudh said. I think as long as you're intellectually honest, able to listen to the other person, not let egos come in the way. Sometimes these conflicts can actually lead you to a place of a larger leap forward in terms of your startup journey. So given that there is this difference, what can you get out of it? Is there a way to reconcile? If not, I think it doesn't make sense to have someone with so much equity on board who does not believe in the company anymore, because it again affects the momentum of everybody else on the team.
Right. And now that there's an alignment, vision, everything, one of the audience has a question saying, how do you stay on course in building and focus on getting things done? And while you do that, how are you going to motivate the team to make sure you're all aligned? Because the journey until we get the product market fit sometimes might be a year and a half, or even longer. Any thoughts, any tips, any tools, Anirudh?
Yeah, I think first it comes back to what Shui is saying. If you have aligned values in the company, I think that will make things much easier. People understand that this is not a road to great fortune. It's actually a discovery process of whether you can find a market for which your product is a fit, or you find a market that you can service. I actually feel like market-oriented thinking is better than saying my product can go here. It's more about what market can I service. So I think that bringing that mindset in, and strange, right? Like we work a lot with creative people, and creative people often think product and their creation first. I want to bring my creation to the world. This author's version, which is one of the big reasons why we created this company, because I dislike that way of thinking. But you see the same thing in any cafe in Bangalore. People want to push their product versus thinking about the market first. I think that alignment is required, I think, at the beginning, because that then allows you to not blame the product, but actually, or blame yourself, but actually look at the market and say, oh, maybe there's just not enough people who want this, right? It makes things easier. And then it becomes a discovery process. Hey, who's my market? Who's the guy? Who's going to use it many times? That reframing of the problem is important. Second is that listening when someone joins, which I was mentioning earlier, because one thing I found, a lot of people have strange notions about startups, right? That you get free food. When usually I ask, what's your favorite startup? Everyone says Google. And Google is not a startup, right? Like, I mean, what more do they have to do now other than dominating and being a monopoly that show that they're not a startup, right? So I think, people who worked in startups know that, the grind, that it's a grind, right? So I think that alignment is important. And then motivation comes from celebrating small wins and doing enough sort of just check-ins, and everyone has their own method of doing this, right? Some people are leaders by like they motivate, they're more like managers and coaches in that sense, right? They motivate by the way they speak, the vision they show. Other people do and walk the talk. They're like some maybe a great technical leader is able to solve a great problem and able to guide you and mentor you on your own technical journey. That there are many leadership styles. There's not one, right? Like you said, there's many paths to success. So just because you don't speak like Steve Jobs doesn't mean that you're not going to be a great leader. Bill Gates is just as good. In some ways better, I would say. I know it's a bad thing to say in the startup world, to praise Gates over Jobs, but but they don't look anything alike. They don't behave anything alike, right? And same with Zuck, like looks so different from anything else, the other guys. So you will find your own way of motivating people, and don't let that bother you. But definitely make sure people are aligned, because no speech will work if their values are not aligned with you.
We're right on time. We're going to take the last question, and then this is more on equity. How do you divide equity within early team / co-founder? And is there a framework for equity split or something like that?
You'll find enough benchmarks, on the web here, but there is unfortunately no right way or no right answer on how you split equity. Maybe just drawing from patterns I've seen, if other co-founders come on board after a financing round has been raised, they typically end up getting much lower equity than if you come in pre-financing. So in some sense, if the risk goes down, of the company failing, then whoever joins after, their returns also get capped a little bit. So it's really about the risk return profile and, what stage of the company are you entering, which I think is the prime driver here. But say pre-financing, if there are 3 people, it's very hard to say whether it should be equally split or not. I think in general, I don't, put too much emphasis or I don't think we should over index on kiska idea hai, because an idea is just the starting point. There is so much navigation to be done. So I don't think that is a reason to give someone higher equity. But if someone can differentially attract talent, differentially attract capital, then those are reasons for that person to negotiate up in terms of equity. But beyond that, if all 3 of or whatever, all 2, 3, 4 of you are in the same boat, then maybe just splitting it equal is the right way to keep everyone motivated to the same extent.
Wonderful. Thank you. Before we end the conversation, I would like to say there was a question from one of the participants saying, how do you maintain and build culture? I think that's something that we would bring in as part of a Pay It Forward series going forward. We will certainly share larger insights on culture and many different aspects of building an organization. Like we always believe, great organization comes with great people. So it's an opportunity for you to build your organization with greater people. So with that, I'm going to hand over it to Karan. Thank you, Shuvi. Thank you, Anirudh. It was wonderful talking. And I've learned a lot from this conversation, and look forward to learning from more.
Thank you, guys. It was so nice to discuss these sort of things. I feel we don't discuss them enough.
Yeah, absolutely.
Yeah.
Thanks so much, Karan and team, for organizing this.
Absolutely, guys. Thank you. I think Anirudh said it well. We don't talk about these things enough. They're tough topics. It's tough to get like the kind of insights you guys have shared, and it's certainly been eye-opening for me. And I could not have thought about a better person than Narayan to kind of go deeper into this. So Narayan, thank you so much for taking the time. I hope this was useful for everyone sort of joining. I've shared a link on feedback. Please do give that to us. It helps us plan better, think better, and course correct wherever we can. But I think we've had a great session getting insights from Fundraise from some of the best investors. As Anand said, the top 3 investors in the country were there, which was great. And I think Gaurav gave some really phenomenal, straight from the heart advice. And I think phenomenal way to end on a Saturday. Thank you again, guys. It was great to have everyone. And we look forward to seeing you again next time.
All right. Thank you.
Thank you.
Thank you, guys.
Thank you.